Vanguard makes an incredible suite of ETFs that can complement any investor's portfolio. They have Canadian ETFs, American ones, and they are a fantastic way to get exposure to one or both markets. They also have options for Europe, but for the scope of this video, we're going to stick to Canada, and we will begin right now. The Vanguard Group is an American investment advisor based out of Pennsylvania, and globally, they manage roughly $9.1 trillion of assets. Holy banana bread. That is not a number you can sneeze at very easily. In the US, they are one of the top 3 index fund managers. They may be based in the US, but they do have offices in Canada, Australia, Asia, and Europe. Well, when you are thinking blue chip ETFs, Vanguard is quite literally one of the first names that most folks think of. Of course, we're going to figure out if they really are worthy of the blue chip title. Before we do that, let's take a look at where Vanguard comes from. So the founder of Vanguard was a gentleman named John C. Bogle, who had written a grad school thesis about why most mutual funds could not outperform the S&P once the management fees were factored in. Upon graduation, he had worked for Wellington Management Company, and he worked all his way up to CEO of the company, but then he was fired as their CEO in 1974, basically as the collateral damage in a merger. Now, at that point, Bogle had already had the dream of creating a Vanguard fund named after the HMS Vanguard, the ship of fame in Nelson's fleet. Having left Wellington, he took the name with him, though he was forbidden from engaging in advisory or fund management services. Instead, he turned it into a passive fund which he tied to the S&P 500. And the Wellington board, well, they were okay with that. They did approve that fund. That fund became known as the Vanguard 500 Index Fund. With their initial IPO, Bogle only raised $11 million when he was trying to raise $150 million. However, despite that, and of course the banks were telling him he should quit, he pushed on as he truly had faith in his dream. The fund grew slowly at first, but by the 80s, the fund began to really take off, especially around the time of the 1982 market boom. Thanks to that boom and the overall growth of the fund, they were able to add additional funds that were created to expand Vanguard's offerings. This included a total bond fund and a Vanguard Extended Market Index. Interestingly enough, the total bond fund was the first one that allowed individual investors to buy. Before then, it was only being offered to businesses. In 1990, the first ETF ever was listed in Canada, and it was TIPS, the Toronto 35 Index Participation Fund, which of course tracked the TSX 35 Index. As we entered into the 2000s, Bogle, who was not a fan of ETFs, retired, and with new management, they began to move Vanguard's offerings into ETFs and actively managed funds. This was the beginning of the transformation of Vanguard into the company it is today. One of the biggest goals with Vanguard in regard to ETFs was that they wanted to keep management fees as low as possible. And in fact, they have done that with average fees that are 57% lower than the industry average. In Canada, since 2011, Vanguard has cut their average management expense ratio, or MER, by close to 50%. This translates into about $10 million in savings to Canadian investors. I certainly cannot argue against that. Now that we have a little background on Vanguard, let's get to why you are all here, to look at the ETFs, of course. Before we jump in, if you are looking to add an ETF, or maybe you are fresh to investing, in which case these may be ideal for you provided you do your due diligence and consult your financial advisor. With that aside, these are ideal ETFs to add to your Wealthsimple portfolio. If you do not have Wealthsimple, I can only guess you are not a fan of commission-free, no-limit trading. In all seriousness, Wealthsimple is by far the best online broker in Canada, and if you try them out with my link pinned down below, it's in the first comment, you will get 2 free stocks as a welcome, which is not a bad way to say hello. So let's get to those ETFs. We will stick with the Canadian ones for today's video, and honestly, the American ones are struggling a little more in the current market downturn compared to, well, our Canadian ones. For Canada, there are 43 Vanguard ETFs to choose from. I am not going to cover all of them, but for a complete list, just check out Vanguard's website over at vanguard.ca. I will, though, highlight to you 5 of their best ETFs for overall total returns. Keep in mind that with these ETFs we're looking at right now, the market is in a current deep correction, if not on its way into a recession. So some of these numbers are not looking super impressive for this year. But with that being said, let's go to our first ETF, and that is the Vanguard US Dividend Appreciation Index ETF with a ticker of VGG. This index tracks the S&P US Dividend Growers Index. This is a fund that has been around since, 2013. They have a low management expense ratio of 0.30, and their management fee is 0.28%. Their yield comes in at 1.32%, and that is paid out quarterly in the amount of 18.3 cents Canadian per share. Let's take a look at their growth. In the last year, their price rose from $63.99 to $66.67, which is only a return on investment of 4.2%. No doubt, this looks low, and the current crash is to blame for that. However, when we zoom out and look at the bigger picture, their 5-year saw the share rise from $42.46 to $66.67 for an ROI of 57%, which averages out to a typical yearly return of 11.4%. And once we add in the dividend, that takes us up to 12.7%. Of course, keep in mind, if the market recovers this year, these numbers will look a lot better. Our next ETF is the Vanguard S&P 500 Index ETF with a ticker of VFV. This index tracks the S&P 500 Index. This is a fund that has been around since 2012. They have a low MER of 0.09%, and their management fee is 0.08%. Their yield comes in at 1.17%, which is, of course, is paid out quarterly in the amount of 24 cents Canadian per share. Let's, of course, look at their growth. In the last year, their unit price rose from $90.36 to $93.13, which is only a return on investment of 3.1%. No doubt this looks really, really, really low, and the current crash is to blame for that. However, when we zoom out and look at the bigger picture, their 5-year saw the share rise from $57.84 to $93.13 for an ROI of 61%. That, of course, will average out to a typical yearly return of 12.2%. And once we add in the dividend, you will get 13.4%. Still, not a bad return on the longer term scale. Keep in mind, in January, they were at $109, which would have been a 17% higher story than the one we got. Our next ETF is the Vanguard FTSE Canada Index ETF with a ticker of VCE. This index tracks the FTSE Canada Domestic Index. This is a fund that has been around since 2011. They have a low MER of 0.06%, and their management fee is 0.05%. Their yield comes in at 2.68%, and that is paid out quarterly in the amount of 34 cents Canadian per share. Let's, of course, take a look at their growth. In the last year, their unit price rose from $42.47 to $44.78, which is only a return on investment of 5.4%. Still, looking a little low, and of course, the current crash is to blame once again. However, when we zoom out and look at the bigger picture, their 5-year chart saw the share rise from $32.59 to $44.78 for an ROI of 37.4%, which averages out to a typical yearly return of 7.5%. And once we add in the dividend, you'll then get 10.2%. This is really not a bad return for a long-term investor. And once again, with some market recovery, this is a number that will go up a good amount. Our next ETF is the Vanguard FTSE Canadian High Dividend Yield Index ETF with a ticker of VDY. This index tracks the FTSE Canada High Dividend Yield Index. This is a fund that also has been around since 2012. They have a low MER of 0.22%, and their management fee is 0.20%. Their yield comes in at 3.54%, and that is paid out monthly in the amount of 14 cents Canadian per share. And of course, now let's look at their growth. In the last year, their share price rose from $39.77 to $45.47, which is a return on investment of 14.3%. With the current market conditions, that is actually not bad at all. It kind of borders on amazing. Of course, we will still zoom out and look at the bigger picture. Their 5-year chart saw the share rise from $32.61 to $45.47 for an ROI of 39.4%, which averages out to a typical yearly return of 7.88%. And once we add in the dividend, you will get 11.42%. Thanks to monthly dividends, this does tend to be one of the more popular ones. Their ROI will look great once the market recovers, so not a bad pick at all. Okay, we've now made it to our top spot. So our top ETF is the Vanguard FTSE Canada All Cap Index ETF with a ticker of VCN. This index tracks the FTSE Canada All Cap Domestic Index. This is a fund that also has been around since 2013. They have a low MER of 0.05%, and their management fee is 0.05% as well. Their yield comes in at 2.60%, that is paid out quarterly in the amount of 32 cents Canadian per share. Okay, let's look at their growth. In the last year, their unit price rose from $39.95 to $41.46, which is only a return on investment of 3.8%. Yikes, that looks low, and of course, the current crash is to blame for that. However, when we zoom out and look at the bigger picture, their 5-year chart saw the share price rise from $31.25 to $66.67 for an ROI of 113%, which averages out to a typical yearly return of 22.6%. And once we add in the dividend, you get 25.2%. That is really not a bad return for a long-term investor. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.